Are you looking to simplify your investments? Check out BMO ETFs. Your asset allocation can have a major impact on whether you will meet your financial goals, so it's no wonder Canadian investors are turning to asset allocation ETFs to complement their portfolios. BMO offers easy-to-use solutions such as the BMO Growth ETF, BMO Balanced ETF, BMO All-Equity ETF, and more. These ETFs invest in a number of underlying index-based ETFs and are rebalanced automatically. What was once a popular mutual fund strategy is now available through an ETF with the introduction of the T6 units. T6 units provide a 6% annual payout on a monthly basis, helping retirees meet their cash flow needs. This is available on their balanced and growth asset allocation ETFs. Regular rebalancing means you can spend less time planning your life and more time living it. Learn more at bmoetfs.com. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 88. As always, joined by the three amigos. We got Keith Dicker, IceCap Asset Management, Rich Diaz, Acorn Macro. What's going on?
Me? Oh, it's beautiful weather in London. It's been 25, 28 degrees every day for the last 2 weeks, which is fantastic. And yesterday after my client meeting, I took the afternoon off and just cycled around all of London with a big smile on my face. But that's not important. What's important is we have some corrections and follow-ups from last week. Very quickly, Cato, C-A-T-O, was an influential Roman senator. There's also Cato from the Green Hornet, which is what Keith was talking about. And finally, my favorite, which is catastrophic at takeoff, which is apparently an acronym used in rocket rocket science. Anyways, there you go. So Keith, there you go. Now you're informed, Keith.
Yeah, I mean, because I think we were all over the map with the Cato one. But the guy that I'm thinking of actually is Cato Kalin. Again, the guy, you guys were too young to remember this, but a long time ago, this American football player, O.J. Simpson, was allegedly murdered his wife. Anyway, one of the star witnesses was this guy that lived in his pool house, a bit of a surfer dude. His name was Cato. So that's a popular name. Maybe you guys can use it if you guys have children together one of these days.
The Green Hornet.
No, Cato.
Yeah. We're starting off strong today.
Yeah, speaking of, just to quickly touch before we get into the episode, is the Vancouver event. People have been asking about tickets. Trust me, you guys will be the first to know when the tickets are released. They'll go out first and foremost to our previous attendees. But if there are any businesses out there that want to entertain a sponsorship for the Vancouver event, July 27th, please send us an email. Likewise, we're also going to be doing like a meet and greet a couple days later in Calgary on Saturday, the 29th. So we're actually still trying to figure out a venue. So if you've got a venue that can fit, 75 to 100 people as a social meet and greet, local bar, whatever, brewery, we're all ears. Also looking for sponsorships as well. So again, if you've got anyone, know anything, recommendations, send us a few emails. We'd greatly appreciate that. But I think it's time to dive into this week's episode, Rich. We've got, you and I were getting into it with the Twitter trolls prior to this launch of this episode, just looking at some of the national housing statistics that came out today. And so it's kind of more of the same, and we're going to kind of dig through this, but new listings continue to be sort of the primary story, I think, coming into this year. So if you look at, month of May, it was the fewest number of new listings on a nationwide basis since outside of May of 2020, which was the start of the pandemic, May of 2009. So you've got these 14, 15-year lows in new listings. We've had 20-year lows in the past. So it kind of continues to be that story, which is quite fascinating because, again, everyone, including myself, coming into this calendar year was like, listen, interest rates are up. There's going to be stress forming, investors, negative cash flow, highly indebted households are going to have to put their homes onto the market, and we're going to test the inventory levels. And it's actually been the complete opposite so far.
Yeah, so Keith keeps warning us against arguing with people on the internet, and we keep ignoring him. Maybe this is the time it finally sinks in. Yeah, it's obviously. I mean, you were. I mean, don't be too hard on yourself, Steve. You were right about this. It's a supply issue. I would say be patient as far as people eventually getting squeezed and putting that kind of stuff on their listings back onto the market. But that's obviously an area much better. I thought it was interesting that we're having a sort of a similar story in the US, which is a market I know much better. But back to Canada. I mean, I did see that the sales recorded were actually increased between April and May. So is that more of the same?
Yeah, I mean, there's no question you've seen this rebound in sales. Like it's still, they're up year over year compared to last year, which I think is the first time since 2020. So sales are definitely recovering. I wouldn't say they're red hot. I think you're kind of near your long-term average for monthly sales. So it's, the demand is okay. I just think like what we're seeing, like feet on the ground, is basically most of the demand that's being driven today is from these like young families. They need to enter the housing market. They're not waiting for like the big crash that may or may not happen. Like, they've got a kid, they got a second on the way. They need to upsize. They need to go to a certain school catchment. So they're moving, and they're just having to transact in an environment with very low inventory, which is creating these, multiple offer bidding war situations, and thus driving the prices up. You're not seeing the pandemic era where all these investors were adding to their portfolio. Like that's just that demand is still not there today. Which makes sense. I mean, if you think about it, if you're an investor today, yeah, the rents are up, they're up, decent amount, but they're certainly not enough to offset your mortgage costs. I would actually argue that, like, at least in Vancouver, like a 1-bedroom condo, which is what most of these investors are buying, prices are up. I mean, in Vancouver, they're hitting new highs. And so as an investor, the numbers just don't pencil at all.
Can I just ask another question? So in the UK, there's estate agents here. They have a bad reputation, but for the most part, I'm sure they're okay.
We all do.
And they do. No, you're great. Call Steve. Anyway, but they do both rentals, and they sort of do some kind of property management, and then they also do sales. And from that, and because they're able to do that, they actually see both sides of the market. I don't know much about your business, to be very honest with you, but do you do that as well? Do you do rentals and that kind of stuff? Or is that a totally separate business in Canada? And
I don't. I mean, there's some agents that do. It's technically an additional or different license. I just find, like, at least in Vancouver, it's like, yeah, I mean, most of the really, I find to be truthful, is like most of the successful agents typically aren't doing both, just because like the rental market is it's just not really worth your time and effort, in my opinion.
Okay. Because I have a follow up because I know here, because the interest rates have gone up so much, and so you can see for variable rates you're in the sixes, and it's the same exact situation. So people are just moving out of purchasing homes, and now they're just renting. And so there's been a lot of impulse on the rental market. I know this because I may or may not be trying to get rid of my flat here in a couple months, and so you're seeing the rental. And I was just wondering if that was what's happening. Are you going to rent out your place? Yeah, I'd like to. I'd like to sell it. No, I can't. I mean, I don't want to. I get my license over there. Well, I mean, this is a bit personal, but buying the flat in London was a complete disaster as far as an investment is concerned. I bought at the peak in 2015. I should have listened to you probably. But I was smart enough to lock in my mortgage rate for 10 years last May. So now it's basically 2%, 2.09%. I mean, you're paying off like what, 55% of your payment is principal. More than that, actually, more. Yeah. It's like almost 3/4 actually, or 2/3 or whatever. But can we talk about the housing starts? Yeah. Well, I mean, yeah. So on the same day, housing starts rolled over significantly. Rich, you've got the chart. I mean, I've been following it, but I think, because I was looking at the April numbers a couple of weeks ago, and of course the May numbers are telling a different story. Yeah. So it's 202,000 housing starts. So it's an annualized, seasonally adjusted number. So there's some shenanigans involved. But I think the more important thing is it's sort of back to the 2015 to 2020 trend. So the pre-pandemic trend. there was a big jump in 2021. I promised to share this chart. And so we're sort of back to this like, longer term trend. And that longer term trend, in my view, is just not good enough. I mean, the argument we got in not to give this guy too much credit, but the argument we got on Twitter was that, it's to do with immigration. He said, no, it's to do with monetary policy. I'm going to blow everybody's mind here. Sometimes it's more than just one thing that it works in concert with another thing in order to push up or down an economic or financial market variable. So I think we need to move away from this like linear thinking where it's just one thing or just the other. Sometimes it's both. And anyway, sorry, I don't know, Keith, if you wanted to jump in there.
Well, right now I'm still staring at, for those that watch the video, like Steve's wearing a new shirt today. I just can't stop staring at. Don't you see that? It's really nice.
Well, you have nice glasses.
I know. Yeah. We're all getting fancied up.
Right.
I'm just like, the whole real estate narrative. I'm not strong in that world. I know, a lot, but not to have a strong opinion on it. But the point you just made, Rich, is absolutely correct. In that it's the same like the conversation we had with Robert last week, in that you can never have just one factor moving. One factor influences another factor, and the degree by which one moves, it could have a greater or smaller effect on another one, and so forth. But so you see that coming along here. But it is fascinating though to watch the entire rent versus own debate or conversation that's taking place. And of course, you can have the real estate market getting softer in some markets, but yet the cost of financing has gone up. So it's actually more expensive for some people. So I still have the view, we'll get into what the central banks have been saying this week, because there's a lot of data came out. It was a pretty exciting 48 hours. Exciting, for, central bank wonks, but it's, we are still set up here now to either we will never have a recession again, which is, by the way, with every single member of the Fed, that's what they're predicting as of now, that there's no recession coming up. Anyone following the Bank of England, they went from predicting like the worst recession ever to they're not having a recession and they're going to jack up rates. I think, Rich, by 75 beeps over the next year.
Yeah, there's more and more hikes getting priced in.
We'll get into all the central bank stuff here. We got US CPI, we got some stuff out of China. So we're going to get into all of that. But, to circle back on like Rich's point that, like there's so many factors, right? It's like you've got foreign capital flows. We know that obviously you had the China wave in 15, 16. You've got like, I don't think like Rich, you and I can both agree, like I think Keith too, like the primary driver I'd argue for Canadian housing for price appreciation has been cheap and abundant credit for going on a decade plus. Like, yes, immigration for sure is playing a factor. The inability to actually build housing to keep up with that immigration, definitely a factor. And so it's never like one thing, and people get all upset because like, Rich and I are pointing out like immigration and housing starts, immigration up, housing starts down, not a great outlook.
But it's also a bit of it's also a bit of a, maybe this won't come out the right way, but the whole housing story in Canada is a bbit cultish as well.
Totally.
In that you don't own a home, you got to own a house. You don't have a house. I have 3 houses. I have 4. You have a lot of that going on, then, absolutely, low rates and really good credit, enable that to go further. And then, a decade with I know Alberta had a rough time there in 2015 when oil came off, but generally there hasn't been a recession floating around in Canada for a long time. And then, of course, you got the immigration story at the tail end of it. So, don't feel bad if you feel like you're being left out, because it's just one of these phases we're going through, and phases always self-correct, guys. So sometimes patience really does. But Rich,
it's definitely a disturbing trend. I get it, right? Like, I don't know. I'm in the millennial cohort.
Keith? Oh,
sort of. I can't believe you're not going to sell your flat in London.
We'll see.
But well, Keith, to your point there on mortgage credit growth in Canada actually coming in Q1 of this year, coming in at a 20-year low. 20-year low for credit growth, which is going to be interesting because I think like. So basically the Canadian households added net net 11.2 billion in mortgage debt in Q1 of this year, smallest increase in 2 decades. But I'm interested.
But a lot of that, Steve, though, like some people think that might be consumer driven. A lot of it is bank driven as well.
Yeah.
And like anyone else that is issuing credit, because all of a sudden we've gone like from 2 years ago where, yeah, like, lend money to someone even if they don't have a heartbeat, just give it to them. And now they're probably being more selective. So less people may not be able to qualify, or they cannot qualify for as much as what they needed before. It still means that there's, the supply hasn't kept up. But I'm just commenting that to have low credit growth, it can come, as Rich mentioned, it's a new theme for today. It can come from a number of different factors, and one can be linked to the other.
But on the mortgage,
this reminds.
Rich,
oh,
go
sorry.
ahead.
I was going to say this reminds me of another pickup line called multivariate. That's what you call it when you're doing analysis. When you have more than one thing, there's univariate, which is just one thing, bivariate, and a multivariate. And what Aslan was talking about was like a multivariate analysis of a particular outcome given certain impulses. And so there you go. There's a new pick. We haven't had a new one for a while, so there's one.
Which one is yours? Which one is yours, Rich?
Multivariate.
Well,
I didn't mean your flat. Your line, which is your. Maybe that's why the success. Okay.
Keith, on the mortgage credit side, though, like the thing that I find most interesting is like that's, mortgage credit growth is one of the largest drivers of the origination of new money into the system, right? Like banks create money by originating new loans, and particularly, obviously in Canada, new residential mortgage loans. And so the fact that you're running at 20-year lows, you would imagine that as credit growth becomes relatively benign, that should, in theory, slow the economy rather considerably.
Yeah, absolutely. Because, the economy grows at a, you have a velocity of money. You guys might know that phrase, of course.
That's a good one.
For another pickup line, the velocity of money.
Have you heard about the velocity of money?
But we all know what the classic calculation is or formula is for GDP growth. You have consumption by government, corps, and households, and then plus your net exports. I think I left anything out. It's all in there. And that's your plus absolutely. You're changing inventories as well. And but another way it's a theoretical way to calculate GDP growth. So you probably heard in the industry before, top down and bottom up. So from this perspective, the way you calculate GDP growth, this is more like a bottom up perspective. And some may disagree and say, no, it's not. It's still at that level. However, there's another way that you can estimate the strength of an economy. And it's by looking at the velocity of money. And on what it measures, technically, you can add the growth in the money supply. And this is where it gets a bit Hollywood-like, or a bit of fiction thrown in. But you're assigning a multiplier to it. So it measures how fast is money swishing around in the economy. And that's where you get the calculation for the velocity of money. So if you know what the increase, if you know what the change has been in money supply, and you already know what GDP is estimate maybe from the private sector or something, you can work that out and see, hey, that's the velocity of money. So it's a common thing people look at. How fast is it swishing around the economy? So to Steve's point, if there's less money being made available to the economy, it means there's less money available to swish around, if you want to look at it from that perspective. But it's incredibly important, because if no one can get any, just say we have a world where there's no credit provided. So think of a nice, happy world for governments where they're only spending the tax revenues that are coming in, right? So there's no leverage going on. In that world, you don't need credit. So you're just driven by, your regular income coming in. But if we had that scenario, that's why we talk about, and I've been sharing my view that I think we have a probability of a very strong credit crunch coming up. That means that the household sector and the corporate sector won't be able to borrow, not as much as before. And if that happens, this means there's not as much new money coming into the system. So if at the household level, maybe it's, for holidays or or just regular spending and stuff like that. If it's at the corporate level, maybe it's for capital investments, a new manufacturing plant and stuff. But if we get into a credit crunch where there's less capital being made available, the velocity of money will come down further, and that's how you get that slowdown coming up. So yes, Steve, you are right with less credit coming into the system in Q1. It's not positive, that's for sure. So we'll see which way it turns here on the way up.
Yeah, no, I mean, just to kind of summarize there, I've been watching building permit data, which is down, the lowest levels since December 2020. Building permits being a leading indicator ahead of housing starts. So now, obviously, Rich, we're seeing the housing starts rolling over. And so I just look at it and say, at the end of the day, yes, the national housing market right now is still tight because you've got very low inventory, but you don't have a ton of volume. Volume's still relatively benign. You've got 20-year lows in mortgage credit growth. You got building permits running at very low levels. Housing starts starting to come off. And so I think of all that economic activity that is derived by housing in the Canadian economy. We know that it's sort of a one-trick pony in this country, that I still think things are going to slow materially. And so, I think people that are chasing the housing market, I think there's still, caution warranted. I think the next 12 months could be rather bumpy. So I think that kind of rounds out the housing stuff.
Yeah, I mean, just to finish off, but the bumpiness, we're not trying to scare anyone away from buying a home, because, I'll always say buying your home is different than buying a house, which is your, an investment property, your second or third unit. As long as you're going to continue to have income coming in to service this debt that you're going to have, then you'll be fine. But that's where we come back to the whole recession story here. So if you have a rock solid job as a realtor or a global macro strategist or a money manager, we're all fine. But seriously, it's the economy that's going to determine whether, you're able to meet the funding cost. Is anything coming up?
Yeah, no, that's a good point. Which kind of leads us to, the next conversation, which is the Fed. We had the Fed, the ECB, Bank of China as well. Is that what you call them? Bank of China?
People's Bank of China.
PBOC, baby.
Yeah.
PBOC.
Rich, I guess, leading up to the Fed, you had US CPI. I don't know if you want to quickly cover that. It seems like it kind of came in on the screws in terms of expectations, but.
Yeah, I mean, I got the feeling that everybody was like cheering that that inflation fell, which again, so month on month prices went up. So headline was 0.1, core was 0.4. We know that year on year inflation is still coming down, but prices are still rising. So that was the thing I thought that was quite interesting. I think there was a couple of mistakes in the analysis. One I got from my client, it wasn't even me who picked up on it. People were talking about how insurance costs are blowing out and that's like a one-off. It's actually to do with electric vehicles, which is really interesting. There's a certain company, I'm not sure if I'm at liberty to say the name of the company, but there's a certain company that fired their CEO because they misunderstood the changes in insurance premiums and write-offs related to, for example, electric vehicles. So because Teslas are very difficult to repair when you have an accident in Tesla, you have to write it off, and that write-off number is much higher than with like let's say a comparable four-door sedan that's an internal combustion engine. Anyways, so that insurance premium is jumping. So that was really interesting. Things that we talk about a lot, I'm not going to go over too much, which was shelter continued to rise. So yes, the contribution is falling, but we know it's lagging, but it's still positive. Energy continues to drag down on the headline stuff, and in general, core is still quite high. I mean, and so the story is the same. Peak is behind us, and prices are rising, but just at a slower rate. Keith.
Yeah, I mean, so very quickly, all the inflation data, it's growing at a slower rate than the month before and year over year. It's going that direction. If you're looking at core year over year, we're at 5.3. I mean, so if they want to get that magical 2% rate, it's still a ways to go here. But the market got a bit excited, right? Because remember, this came out on Tuesday, and the Fed was come the next day. So all the inflation data, it was still kind of hawkish. Like there was nothing in there to say, oh, wow, yeah, the Fed is going to stop. But there was one number that I know the Fed looks at quite a bit, and they're looking at the average hourly earnings and weekly earnings. So the previous month's earnings growth, now earnings is for individuals, what we're making for income. So down for the Americans, the revision from the previous period became worse. So it was more negative. So that's dovish. That means, hey, people have less money to spend. And then for the current month, it was pretty soft as well. So then that sort of helped the market say, yeah, okay, let's go on to the races again. And then we jump to Wednesday, the next day.
But wait. I think can I just jump in there? Sorry. I think often we get stuck with just repeating the numbers, and that's fine. And it's easy to do. I think in general, people just need to, this is my personal view. I don't mean to speak for you guys. I think people just need to make peace with the fact that inflation, full stop, will be much higher than what we've dealt with the last 10 years. There's several different reasons why this is true. We've talked about it on whether it's demographics and structurally higher wages, whether it's budget deficits that refuse to go anywhere near balancing themselves, whether it's the IRA, which is subsidies, whether it's squeezing its investments in electric vehicles and green energy, which is inflationary. You can argue with me about that some other time, but that's my view. So I just think we went from a world where it was 1.5 to 2, and that was basically 10 years of that. And I think we're just now structurally a new level of the 3s and the 4s for many, many reasons. But so I think I think there was just more evidence of that. In my personal view, I don't know.
What is the IRA that you mentioned? I know almost everything you say all the time, except every now and then I'm like, what the heck is he saying? What
sorry. The IRA is called the Inflation Reduction Act, which is one of Joe Biden's, I would say, banner legislations. I think it's an absolute misnomer. It follows on from the CHIPS Act. Don't ask me what that stands for, but basically it's about bringing home supply chains in America and building up a barrier between America and China. This is maybe a conversation that we should explore with somebody who's more of a China expert, but basically the world is bifurcating, and which means to split into two, and it's basically China versus the US. This is the next 100 years that we're about to deal with. And the America First doctrine, which was started by Donald Trump, has been absolutely carried by Joe Biden. Joe Biden is just the better marketer of that view. And the Inflation Reduction Act, in my view, is extremely inflationary because it means subsidies, and it means tariffs, and it means making supply chains less efficient and pulling them away from China. Now, that's a bold statement, which maybe, Steve, we can talk about some other day, but that's what the IRA is.
I was just thinking about still focused on inflation here. I was looking at I've just got this Trueflation chart in front of me. I know you guys like to chirp it, but it's sitting at 2.34% right now. True USA, Trueflation. So if you don't believe the government, the conspiracy theories, you don't believe the BLS, whatever, it's Trueflation is coming in at 2.34. So U.S. headline inflation, of course, at 4%.
Rich,
so,
what does the BLS stand for?
The Bureau of Labor Statistics.
I like this new game. This is awesome. This is cool.
No, because I can never remember what JOLTS is. I still don't remember what.
It's job openings.
Yeah.
Anyways. So that kind of leads us into the Fed, though, right? So, I mean, Keith, I know I caught you just before the Fed meeting, yesterday? I know you
woke me up. I couldn't believe it. I was like, wow.
I know you had your popcorn out. What was your overall takeaway from Powell there?
I mean, so I'm critical of Powell for a number of reasons, but just on the face of it, for everyone, what the Fed did, they didn't raise rates yesterday, but they strongly hinted they're going to raise again at the next meeting. So they're referring to as they're skipping. It's a skip, not a pause. Skip. Yeah, absolutely. It was like it wasn't a hawkish pause, which is what some people thought. Remember, prior to the meeting, the market was expecting no rate hike and they were done. So it was a pretty dramatic change. And that's what this statement was. That's what was announced. And again, markets were all selling off as if, okay, wow, they're doing this when they're going to continue hawkish, and even more hawkish than before. Like it just shocked everyone. And then Powell starts to speak. You get the impression when he talks, he just wants everyone to like him. He's just a little, you just do his voice, and it doesn't matter what the words are, but you don't have a strong reaction to it. But he sort of doesn't have, like, during this entire journey with the rate cycle going higher now from 0 to 5. Not once has he really come out with any teeth. He did it once at the Jackson Hole meeting last summer. It was, I think he had a 90-second speech, which I thought was outstanding. And but it is always just sort of bouncing around. And then you get the presser, and he's almost afraid to come out aggressively, and there's a reason for it. I'm sure that we will never be aware of, but we know that was the move with the Fed. They now skipped a meeting, so they're going to continue to raise rates. And I know we're going to other ones, but the Bank of Canada, they started raising rates again. The Aussies are now doing it. The Brits are doing it. We had another central bank out this
ECB.
morning.
Hold on, but if this guy, I'm kind of curious to unpack this. If this guy is so hawkish, right? The hawkish skip, like, why wait? Why not just raise rates now? Why are we wait? Like, why is he waiting until July?
Well,
Good
you can make yeah, absolutely. But you can make an argument that they're not going to raise rates anymore. But instead of coming out with that and letting equity markets especially get further stretched than where they are right now, you come out and you say, hey, we're stopped now. We're likely going to raise again, data dependent and all that. So you try to, you keep the lid on, the top of the kettle, it's moving, it's all this pressure is building up. So they don't want it to blow it sky high. So you want to try to maintain it like that. That's one.
Like, he's essentially just,
but I said last week, but I said last week or week before, I said, hey, like, if I'm at the Bank of Canada, I think I used the example, and they're still not quite happy with where the inflation data points are coming out, instead of this 25, just go 50. If you want to crush inflation, people don't like to hear it, and I'm just being objective about it. You'd literally have to create severe job losses. You need to create losses so that loans are not paid back to the banks and so forth. And so whenever you get an economy where loans go bad, that's highly deflationary for an economy. And so that's what they need if they really want to bring inflation down. But as of right now, like this, what I can hear from Powell yesterday, and a lot of the data supports as well, it sounds like they're quite happy. They're saying, hey, we achieved a soft landing. Now, of course, the Canadians said that. Was it 3 months ago? Remember that, Steve?
April.
Yeah. Tiff
was it April?
Happy.
We're in June. Yeah, remember that? And then all of a sudden, like 2 meetings later, they're back on again. Are they on the wagon or off the wagon? What would it be?
They're on the wagon, right?
They're on.
I don't remember.
I feel, to your point though, right? If the BOC came out with a surprise 50, I think even the 25 last month or this month, I suppose, was a bit of a shocker. Like, I know, like, people that are in the real estate sector, which is obviously seeing, some resiliency. I think it does start to change the sentiment, right? Like, how much of inflation is psychological?
It's a lot, because we refer to that as inflation expectations. So if you, for example, if you think that the price of a new car is going to be higher next year than it is this month, and you're in the market for that big ticket item, you're going to say, I want to buy now. I'm not going to wait, because then I'll have to pay more. So if all of a sudden, though, and then to do that, it'll increase my credit and credit stress, stuff like that. But if you get the entire population or the economy, including households and governments, to have the belief that, hey, prices are not increasing, I don't have to scurry around to do things, I can just live a normal cycle, then that's what they want for the economy. So that's why you sort of have to temper it. But I'd be a great central banker. I would just say that.
Rich, you got a comment? Go ahead. I got something to say too.
Yeah, just really, really quickly. It was just like it's something that Mario Draghi, who was the previous ECB president, used to always harp on. He used to, in fact, he'd never really talk about inflation. He always talked about inflation expectations. And in Canada, they've become unanchored. And that's another word that he used to use. And it was useful because, and how do I know this? Because the BOC does a survey and they literally ask Canadians, what do you think inflation is going to be in next month, next year, and 5 years or whatever? And, 2-3 years ago, 0% of people, Canadians, thought that inflation would be above 3% over the next 2 years, and now something like 79% of people do. So there's
So
a
why did zero
clear-
think that Rich? Why did zero people think that a few years ago?
Well,
Because
to be
they were
fair,
told. We were told.
Sorry. I mean, no. Before, excuse me, before the pandemic. But to be fair, inflation was relatively stable. I mean, not zero, but it was relatively stable around 2% for a long, long time. And so people got into that sort of mindset that that's what was true. The dangerous thing, and people who live in emerging markets will know this, that inflation expectations, once they start getting unanchored, it has a tendency to run away. Sorry, Steve, please.
No, I mean, I was literally just going to chime in. I know because people have been asking me on like the housing front. So like we're talking about sentiment. So like the Bank of Canada raising 25 basis points. We're now seeing obviously bond yields pushing higher. So mortgage rates are going back up. And so people are like, okay, this is it. This is going to really hammer the market. And I agree. However, if you're expecting that to happen in the next 2 or 3 months, I can tell you anecdotally what's happening is that people that have rate holds right now, because you can typically rate hold for 4 months. So you got a pre-approval, you got a rate hold. I can tell you, like anecdotally, the conversations that I'm having with some people, again, right or wrong, is they're saying, I want to make a purchase before my rate hold expires because I've got a rate hold at 4.8. And when that rolls over, the new rate is 5.3. And so right or wrong, I think you're going to see sort of a little bit of a push of activity as well. And we saw this in the mortgage stress test, right? And you're like, well, that doesn't really make a lot of sense. Why would people rush decision knowing that higher rates probably means potentially lower prices logically? But we saw this in the mortgage stress test, right? Which was like towards the end of 2017, we actually had a blow off top into 2018 because basically everybody that was on this pre-approval wanted to get a purchase in before they were going to be restricted on how much they could borrow through the stress test, which again made no sense because you're like, well, why not just wait until that new rule's fully in place and prices will come down, which they did. They came off about 10%. But I can just tell you like how most people tend to think is not like this podcast and all the our loyal listeners are thinking.
This is a podcast. I thought.
Wait, is this on?
Anyway. I thought we're chatting with Rich's mom. What's going on here?
Well, it goes to show, right? Like I just like the human sentiment, the human emotion of markets can be sort of sometimes hard to predict or rationalize because people are not rational a lot of the times.
Yeah, is Mrs. Diaz going to come to Vancouver?
No, she's gonna be in Portugal. She's gonna be in Portugal. But Steve, that's one more sidebar, if you don't mind, Keith. I'll give you her number offline. But sidebar is that like we're actually seeing it in the equity market, and so we're starting to see that same thing is happening with institutional investors and retail investors as they're seeing the S&P 500 crack 4,200, crack 4,300. I don't know what's going on in the markets today. We're seeing retail investors. We're watching tech go up and just chase the market. And I know because I've been way too bearish this year on risk assets. So that's my bad. But I know that institutional investors who are seeing the year-to-date numbers climb higher and higher are now playing catch-up. And that's back to your psychology, which is you're seeing this number float away from you and you want to play catch-up. I don't know, Keith, I was wondering if you had some light on, you could shed some light on that.
Keith, the PM guy, get in here, buddy.
I don't know what. So you talk about equity market, like no, I'm not trying to be funny right now. But
retail investor, you can see the retail flows have jumped in the last month, and can you blame them? I mean, Nasdaq's up 30%, Nvidia's up, God knows how much it is, and markets are doing well.
Yeah, I mean, it's people used to say, "Hey, you're chasing the market." It's not a bad thing to chase the market, but you can't chase it with it's going up, I have to buy. You need some kind of a model to use, like a trend model of some sort would certainly help you guide you towards, okay, yeah, it's getting a bit frothy. Then what you want to do is overlay that with sentiment data And so sentiment data right now, we have access to some sentiment data. It comes up from DSI. That's the
I wonder how they measure that. Like, how do they measure sentiment in like a chart? You know what I mean? Like, I'm curious. Do you know what they use?
No, I don't. I'd like to have a smart answer for you right now. I will find out the answer to that for next week. We'll go through, but it's a quantitative response from a survey. I mean, that's what it would be. I'm thinking.
Did you?
But
did
you always
go ahead. Sorry.
Well, I mean, with sentiment data, you always want to consider what market sentiment is. So some of the sentiment data we get, it covers every single market imaginable in the financial market world, right? Not in the real estate world. And it goes from 0 to 100. So nothing is ever at 100, nothing's ever at 0. But so right now, these equity markets, especially NASDAQ, like I think it's 90 plus. It can't get much better than that, like unbelievable. And meanwhile, some of these other markets are down like single digits almost. So, from a pure market sentiment perspective, you want to, selling NASDAQ at this point, buying the markets. Like Nat Gas has just been, beaten up incredibly high, over the last few weeks and stuff. But you have that, but you want to overlay with that. If you have like a trend sentiment, a trend and momentum model, and that's starting to roll over. And then you put sentiment on top of it, that could guide you to a successful move. But people lost a lot of money last year, so you can't blame them from trying to chase this higher.
Well, I was just going to rattle off a couple of sentiment indicators that people. So there's like something that's like options. So people use the movement and pricing of options as a sentiment indicator. There's an RSI, which is a relative strength index. There's market breadth, which is the number of stocks in a given index or out of a number of constituents that are going up. So above your 200-day moving average or below. Then there's literally surveys. So there's an American Association of American Individual Investors, and they ask them, are you bullish? Are you bearish? Are you overweight equities? Are you underweight equities? Then there's things like credit spreads that can often indicate sentiment. So for example, sovereign CDS are falling. There's loads and loads and loads of different ones. I don't know what DSI uses, but I would imagine I probably touched on a couple of them, Steve.
I'm pretty sure the Fed actually just came out with a paper. So the Fed just came out with a paper, said Twitter, chatter, and financial market sentiment. So they just published a paper on how FinTwit, financial Twitter, sentiment correlates with market returns and financial conditions.
Not surprised.
And that is not a joke. They wrangled up, 20 PhDs and put that paper together. But Twitter is actually a great sentiment barometer. It's obviously it's not smooth. You can't look at a chart and say, but I think if you filter through Twitter, you can kind of get a pretty good idea of general sentiment
on a lot of things.
A lot of things.
So yeah, I just texted my friend. This is Brent Johnson. You might know Brent's name. I just say, Brent, I'm on a podcast. How is DSI calculated? Question mark. This is Brent, like the smartest guy out on platforms these days. And he's listening, he'll laugh. Brent says, I have no idea. All I know, it goes from 10 to 90 usually. If it's above 90, that's my point. Sometimes people just don't know things.
Well, I mean, apparently it works. But so key. So you have the Fed, obviously hawkish skip, whatever that means. I found it interesting though. Didn't they basically forecast that recession? Like you were talking about soft landing, but I think so the Fed, I guess, updated their sort of GDP forecast, saying that in order to arrive at 1% GDP for the whole of 2023, which is what they're forecasting, you need to see negative growth in Q3 and Q4, assuming the Q2 nowcast. So basically, in order to hit the Fed's sort of 1% GDP target, you're going to have two consecutive negative.
Yeah, I know. Because the way cycles work, the next change in the cycle is a recession just by default, because we've been in an expansionary economy right now, and it continues to get pushed out further. And think of it like we need a recession because it's a normal thing to do. You breathe in, you breathe out, right? That's the way an economy works. When it gets overheated and it's grown too quickly, it will attract money, inefficient capital to a sector, and they get priced out and they have losses, and that's what sort of cleanses the market, the economy, and then we go off again. And a lot of people, including us, we were expecting to be in a recession by Q2, and we're almost like we're days away from Q2 being over. And I think some economists might try to say that there is a recession in some parts of the economy, but it's not. I mean, the economy is still growing well and stuff, but it is getting pushed out, Steve. So for the American economy now to go into a sharp recession in Q3 and Q4, I think that would be a clear shock to the system, and it's certainly not something the Fed is expecting. So it might get pushed out now, say end of Q3, Q4 into Q1. But policymakers right now, like, they're just not expecting it. Same thing in Canada. Especially on the fiscal side. Maybe we went through the conversation with Robert last week. We look at expectations for recession out of the next, I think it was 10 years. It was zero, like it's never going to happen. But that's what the central bankers are talking about now, and that's the soft landing. So they're finally, again, they're congratulating themselves that we've done it, we've achieved it.
I mean, it is amazing to the fact that nothing is truly cracked yet, given the amount of debt in the world and how quickly interest rates have moved. I mean, I think there's a lot bubbling under the surface. There's been some, a couple big banks, obviously, in the US, and, some stuff in the UK, the gilt market. But I guess for the most part, our largest concerns.
I've got one. There's so junk loans. So default. So this is an article from the FT a couple of days ago, which is, so there's
I know that one, Financial Post.
No, Financial Times.
It's an FP. Oh, sorry.
Financial Post is the shitty Canadian version, I think.
No, Financial Times, and it's the pink newspaper if you're ever in the UK.
It's the pink one.
Yeah. And so we're actually seeing leveraged loan market. So basically junk bonds. So there's investment grade bonds, which is a AAA rating. Often given by less than stellar rating agencies, but that's a conversation for a different day. And then there's I can't remember, is it triple B or below? Anyways, it goes from A to, I think, D or F or whatever it is. And so you got, like, maybe companies that don't have as much of a track record, or have much more volatile earnings, or have less assets to back the loans, whatever. Anyways, these are called junk loans, and those defaults are starting to rise significantly. And it sort of makes sense, right? You have much higher rates, you have slowing growth, and you have and then credit basically is being tightened. Maybe not fully yet, but then there's, and the other country that I think we haven't talked about at all, I think is definitely worth noting, is there's a very huge economy that keeps cutting instead of raising interest rates. China is cutting short-term borrowing and doing sort of the opposite of what's going on in virtually every other major economy. So all the Latin American economies raised rates. They're now pausing. Virtually every single Asian economy in the world raised rates, and now they're sort of on pause. And then obviously there's the ECB and the UK. The one major outlier, which is 20-25% of global GDP, is China, and they're cutting short-term borrowing. They just did a couple of days ago, and they're trying desperately to get their economy going back. Keith.
Yeah, absolutely. It's funny because, before you said China, I thought you were going to mention Saudi Arabia. The Saudi. Oh, I bring that up because Saudi. Going on there. Yeah, with Saudi, they don't get a lot of attention except in the oil world, but they, they're getting some attention these days because they are leading, the move for OPEC plus to cut rates. Sorry, not to cut rates, cut production, because they needed that. The estimate ranges from $80 to $85, for the Saudis, to make money to fund their entire economy and stuff like that. But one of the wild cards we have coming up here is that there is some kind of a shock to energy markets to cause oil to go higher. So whether it's driven by the Saudis or it's driven by a geopolitical event or something like that. And as we know, when oil starts to surge higher very dramatically, very quickly, that's negative for the economy. But with the Chinese, I mean, it's something we've been talking about, for some time now. Like they didn't have miracle growth. They just used a lot of borrowing, a lot of leverage. And now that the global economy isn't growing as fast enough, which means they don't have enough foreign capital coming in, like it's stressing the ability of borrowers domestically to pay back the loans. It's putting stress at the bank level. So when the PBOC, what's that one, Rich?
People's Bank of China.
There you go. Then that's good. Yeah. So far, I think you're winning. You're about 7. I have 1, and Steve is still being shut out here on the acronym game. But they're trying to help out the banking system there. They have to do it. But the negative thing though is, so by the way, they lowered rates by 10 basis points. Just to let you know, it's not huge, but it's symbolic. Now, 1-year loan is at 265 now over in China, if you're at that level to borrow. But what also happens, so domestically, as soon as you lower rates, you're getting paid less money in your savings, it encourages even more capital to leave the country. And if you have a closed capital account, that ain't a good thing, because money's trying to get out and leave, and then it arrives on Steve's desk in Kitsilano to buy a house along the way. But China has that going on.
But Steve, I mean, Keith, they've also lowered their reserve requirements, and they've lowered their deposit. This is a structural lowering of all interest rates and interest rate products, etc. And trying to inflate their economy, as you said.
Well, I was reading that
Correct.
youth unemployment in China is like 21% right now, which is, I mean, it's certainly for, you'd imagine for a communist government trying to keep the social cohesion, it's probably not a good thing.
And that's ages 16 to 24. So with that, so remember the Arab Spring, from maybe, I think 10 years ago now, maybe
2011.
2011. Yeah. It was summertime. I call them kids, but young adults, that they weren't able to find work and things like that. And that's when you get civil unrest taking place, because old guys like me, we're not going to protest physically. We'll do it on the internet or something. But when you get a younger generation and they're not happy because they can't make money, they're living at home and all that stuff, you can get an increase in civil or domestic stress very quickly, right? It could happen. So, I mean, the Chinese are clearly worried about this. And they're also, to give you an idea how worried China is about things, you ready for it? You know what I'm going to say, right? What they did in Hong Kong?
I'm holding my breath.
It's not an acronym game. It's just a. So a couple of years ago, when all the protests were taking place in Hong Kong, there was a song called "Glory to Hong Kong." So it was the protest song, and so just over the last, I'm going to say, week or 10 or 12 days, that the government there basically made it illegal. You could be imprisoned for singing this song. And I read that first. I'm saying, oh man, it's pretty aggressive. It's the thought police, of course. But also, what happened next was that all of a sudden the song has been removed from Spotify, iTunes, anything like that. And again, that just tells you that, they're losing control, or they're desperately trying to maintain control on things. So just as, and again, I talk about synchronized risk all the time. It can be financial market risk, but this is social risk that's taking place. So that it is happening all over the world. And again, if China goes, snap in the middle of the night, we'll feel it when we wake up.
I wonder if
Steve,
they,
sing the song, Steve. Do you know it?
I wonder if the Loonie Hour is available in China.
No,
does anyone know?
I'm sure one of our fans will get back to us.
Our fan will let us know.
Yeah,
right.
one guy in China, big supporter.
Yeah,
but we
also had the ECB,
Oh,
ECB today, right?
Go ahead.
Want to do the ECB real quickly, because I thought it was a simple one. So they raised by 25 basis points, which was 100% expected. They affirmed that they're likely, like 99% sure, going to raise by another 25 at the next meeting in July. That was completely expected, but they continue to sound very, very hawkish. Like they came out with the way that Powell should be coming out. Like they were very. Now I think they have less teeth. I don't think they're going to be able to. The reason I say that about Europe, by the way, because so many other external events can affect the European economy, whereas the American economy are really the ones that are affecting other people. Do you know what I mean? Remember the Breaking Bad TV show? Did you guys see that?
I never watched it.
What?
I'm sorry. I never watched. I know I'm a bad person.
Oh dear.
Jeez.
Well, anyway, there's this famous scene during the. Do you know the storyline, Rich? Do you know what
Sort
happened?
of, yeah.
I know it,
Yeah.
Keith. Go ahead. Most of our listeners know it. Anyone
Yeah,
that doesn't live
everyone-
under a rock here.
Anyway, it's this one scene where Walt, at this point, he's head on into the drug world and manufacturing and distribution. He was a business guy as well, right? He knew the right words. But at one point, his wife says to him, like, are we in danger? Like, should we be afraid of like someone showing up here in the middle of the night? And he looked at her and he said, he didn't say these words, but he said, honey, we don't need to worry about that. I'm the one they're afraid of showing
I'm the
up
one who
at their
knocks.
house. Yeah, I'm the one who knocks, basically like that. So that's the difference between, Europe and America. America is Heisenberg, Walt White. This might be a great story. We'll see how this one goes, how it's received. But the Europeans today, they come out extremely hawkish at the ECB level. And it was enough to, surprise them. So right now is a pretty strong risk on day in that world. And so again, all the central banks, they've all of a sudden, they've been synchronized again. They all went from almost pausing to now they're all hiking at some level or another.
Well, I have no idea what any of that Breaking Bad analogy means, but I do know a way of bringing it back down to earth and data. And one really, really easy way of saying it is exports play a much, much larger part of the economy in Europe. So exports as a percent of GDP in the US are like 12 to 13%. It's one of the only economies in the world that can basically be self-sufficient. It doesn't really contribute that much to its GDP. Whereas in Europe, you have countries like Ireland that are 80% of exports to GDP are 80%, but that's a function of the tax shenanigans from big companies like Apple. And then you have countries like Germany, which is 30 and 40%, France, which is, in the low 30s, and you have an enormous amount. And so the global economy is the dog and Europe is the tail. So as the global economy goes up and down, the machinations will affect countries like Germany that are very, very linked to exports and especially goods. And if you'll notice, goods year on year are starting to slow as people have made the shift from, staying indoors and buying things on Amazon to going outside and buying services. And the US is much, much more dependent on services. So I have no idea who Walt is, but I do know what exports as a percent of GDP are very, very large in Germany. And that's why they're at the mercy of the global cycle.
Hey, Steve, how do you think Rich is going to be received online when he's here admitting he doesn't know about Walt White?
Yeah, you need to immediately watch that show today. It's fantastic. I think it's probably one of my top 3 TV shows of all time.
We need the soundtrack on for Rich even suggesting that, right? Click. There we go.
Oh, I'm gonna get killed in the comments.
What about
I can feel it.
Germany's already in recession though, no?
Yeah, Germany's tough, right?
Yeah.
They're just so heavily geared towards global goods trade, whether it's cars, whether it's, they have an incredible engineering.
And sometimes that's bad.
Yeah, exactly. Yeah.
What? Thanks, Rich. One point though on European net exports, and I don't know what the number is, but it is significant. A lot of their exports actually goes to each other, so it stays within Eurozone or EU, depending on which one you're tracking. But some of them, what I mean by them are some member countries like Germany, for example, and so they're a lot more exposed to global trade than say someone like Greece, Portugal, something like that. There she was. What else, Steve? What's next?
Well, yeah, and for the final 10 minutes, we're going to pass the microphone to Rich to rant about ESG.
Oh, no.
We were going to
talk about Ireland and the cows.
Yeah, they're talking about killing all the cows in Ireland. So, I don't know if anyone...
the story that really, I think, hit the airwaves is that I think there's these tobacco companies that have a higher ESG score than like Tesla or what have you. And I'm not going to pump for Elon Musk. I'm not exactly his biggest fan. I'm aware that tobacco kills something like 8 million people a year. I mean, I love a good cigarette on a late night out, but obviously cigarettes are pretty bad, and they have ESG scores that I think trump a lot of companies that demonstrably do not kill 8 million people a year. Hopefully, we're not getting in trouble with that kind of claim. I think so. People who don't know, ESG is environmental social governance, and it's sort of the new AAA rated mortgage or mortgage-backed security of the finance industry. In my personal view, I know I'm going to get a lot of pushback from my colleagues maybe, but I'm very, very skeptical of, number one, sort of the value that they actually can provide investors. And I'm also sort of the view that it's really a marketing shtick that can be abused by people in finance to separate retail investors from their money. Keith, you're in that world. I know that you probably have some pressures on you to do some of that stuff. So I'd love to hear your views on that.
So we have zero pressure from our.
Oh, good.
Yeah,
That's a pleasant surprise.
We have a our clients, except for one guy with the funny shirt there, our clients are very, very much engaged with what's going on. But just a couple of words though with the ESG stuff that people may not understand, appreciate the full picture. So the whole idea of assigning a company an ESG score is that it's then going to either encourage or discourage an investor from allocating money to that company. It's not really from a retail, because a retail investor, you can't guide that much money to really affect an issuance that's coming out, but it comes to the pension funds. So the pension funds have now been infiltrated with this belief as well that they need to, allocate to companies with a high ESG. So when all of a sudden, with a whole bunch of the major pension funds around the world, or even the top 4 here in Canada, when they decide, yeah, we're all in on ESG, we're going to allocate, because of this, they can look at it from the opposite perspective and say, you know what, we're going to allocate even less money to low ESG companies or industries, which is, a lot of times it's energy related companies. So it's a way to, the goal is to make sure that companies that a certain global structure has agreed that should be encouraged, that they will get capital, and then other companies and industries will starve. They'll have to pay more to get capital, and then then over time the high ESG rated companies should be able to do better. But it's all about directing billions of dollars in new capital for investment to these subjectively rated companies.
But again, as a money manager, as someone that is, protecting, preserving, trying to grow somebody's capital, that is your mandate. I think it's just incredibly irresponsible to not be targeting your highest rate of return.
Well, that's the argument that the Texas Attorney General have made, and several other attorney generals and governors in the United States, who, to their credit, were slow to wake up to this, but are now really going after it. And they're suing, I think, still suing places like BlackRock and other asset managers to suggest that they're not fulfilling their fiduciary duties to their ultimate clients, which are in some cases are the voters, or some cases the pension contributors. And it sort of makes sense. It's Keith says it's subjective. I have a different angle, which is I think it destroys information. And just, if I may just take 2 seconds, when you're a bottom-up analyst and you're looking at an individual company, environmental impacts and risks from that company are very important to analyze. So are governance issues. If you've got, Succession is a show that I'm starting to get into. If you have poor governance at the chairmanship or CEO, or there's some shenanigans on the board, that's an important economic and financial risk to that company. And then there's a social aspect, which is, are you paying children to make your shoes? That's a risk from a. And if you're a real blue-blooded bottom-up analyst, you will have already analyzed those three aspects, as well as cash flows, as well as valuations, as well as growth, as well as risks to a particular company's moat or margins, etc. And what ESG scores do, in my view, is that they destroy information because they boil down what should be a multivariate analysis of different parts of a company's business or sector into basically one number. Now, the counter argument people will say is like, that's not true. There's many different numbers. And in my view, I've been in this game long enough to know that if you can rank a 500 companies from 1 to 100, and 1 being the best, quote unquote ESG score, and 500 being the worst, that you're going to start screening. You will take the path of least resistance from an analyst perspective, and I think that's the danger, right? It lacks nuance. And so that's really the issue. Again, a really proper bottom-up analyst will absolutely look at the environmental, governance, and social risks of the company. Combining them into one stupid number that you stick on a stock or a ticker, to me, is not analysis. That's marketing.
It's kind of, I just love what you just shared with us, because there's another score as well, a DEI score that's out there. Sorry. Yeah, as well, which stands for, Steve?
I just asked you.
Steve is 0 on everything here today.
PBOC.
Diversity, equity, inclusion. So DEI. And now I'm at 3. So Rich is winning like 8-3 to 0 right now. Anyway, they sent that out to big companies. That they demanding that they complete this form. Perhaps the world's greatest bottom-up investor, who happens to run an extremely large company, basically said, "F you, I'm not completing this. This is garbage." So Warren Buffett said, "Screw this," and they said, "Oh no, you have to. No, you're Berkshire Hathaway." He's like, "No, we passed. We're not doing it." So yeah, and the other thing to be aware of, because I know the company BlackRock these days is getting a lot of attention as being one of the like the Darth Vader companies out there around the world, and for a lot of good reasons, and some reasons that maybe not so. But they have an incredible amount, an enormous sway into this ESG and DEI movement, and that's because where they run, like, they're the largest ETF manufacturer in the world for both passive and active strategies within their ETF structures. And what happens, because they are the manager and they've allocated to all these countries, for any kind of shareholder board meeting or board meeting or shareholders meeting that takes place, they are immediately the number 1 shareholder. If they're not number 1, they're probably top 3 or 4. And whichever way BlackRock would want to shift a company or an industry's focus or attention, they can do it. So that's why you hear that name coming up all the time. So BlackRock and Larry Fink, that's out there.
Diversity.
But maybe, yeah,
an old wooden ship.
What?
You haven't seen that from Anchorman? Diversity.
No.
What is that?
Oh,
like
yeah.
An old wooden ship?
Rich has to watch more TV.
Yeah,
you guys have seen Anchorman, though, no?
Yeah, I love that movie.
Okay,
Yeah.
thank God. Just to
But here we go. But
Go
one more thing though. But what Rich was bringing up, and I think you've highlighted this, Rich. It seems like this phase of ESG is now starting to roll over, because more companies and pension funds, or managers, I guess, are starting to speak up, and the media are starting to identify it as well. So back to your question, Steve, like, as an investment manager, sometimes like we will have clients and they'll say, maybe we should invest in this or that. And I said, well, how, it's great to feel that way. However, every single company and industry that you can invest in, they're likely doing something you just don't like. It's there. You can't strip out all of it. So the solution sometimes is that, hey, you know what, we're going to have a portion of the portfolio in this industry that you don't like for whatever reason. And if you feel that strong, like at the end of the year, we can donate a part of those, the returns or performance from that sector if you want. Like there are ways to get around it, as opposed to, because if you stripped out your exposures to companies and industries and big names, you just don't like them, then all of a sudden there's nothing to invest in. It happens quickly. Like think of the healthcare profession as an example. Every single healthcare company is doing something that if you heard about it, you'd say, yeah, I don't like that. Same with like the Nikes and you name it.
That's a funny point. I hear a lot of it on like Twitter and stuff about like, landlords are the scorn of the earth, scumbags, anyone that invests in housing. I was like, you are part of Canada Pension Plan, correct? They are one of the largest landlords, not only in Canada, but actually in the United States. They've been buying up swaths of single family housing in the US. Same people that complain about oil, right? I mean, they're tweeting away on their oil-made iPhone.
Of course.
But whatever.
There's one last final point on the ESG thing that I think is a more nuanced view, but I think it's something worth, throwing into the conversation, which is we have a process in democracies, maybe not so much in China, by which citizens can orient where their country is going, and that's through the ballot box and through the legislative process. And that's, we live in quasi republics or whatever it is. And so you obviously vote and that MP does something. And then if you get enough votes, that you can pass some legislation. And ESG, whether people like to admit it or not, subverts, in my view, this is maybe too personal a view, but it subverts the democratic process. Because what you eventually have is you have a very, very small cohort of very powerful people like Mr. Larry Fink, whose effectively views via, proxy voting at the board level through ETFs and ownership of these companies can effectively subvert democratically elected people and the legislative process. And sometimes when they're aligned, everybody's happy, no one cares. But what happens when those two are not aligned? What happens when Joe Sixpack votes one way and the company that is in his pension fund votes against his best interest? For example, to lower energy costs, which I always keep harping on, or to invest in a particular company that does this or that. And so I think, it's a more nuanced view, but I think it's really important. No one really cares when those things are aligned, but when they're diametrically opposed, I think the ESG and that kind of stuff does subvert the democratic process. And I think it's something worth considering when we talk about it.
Yeah,
it's a multivariant perspective.
Multivariant perspective. And just to wrap it up, so it was the S&P Global gave Elon Musk's Tesla electric car company an ESG score of 37 out of 100. But yet it gave Philip Morris, the maker of Marlboro cigarettes, an ESG score of 84. So just to kind of round it out, but we'll leave it there for this week. We don't want to get rich going too much here. As always, we appreciate your guys' support. Just to circle back, if you have anyone that's interested in sponsoring the show or has some venue event ideas for Calgary, like I said, please reach out. We're more than happy to hear from you. And we'll see you next week.